What's up, Colorado? Chris Lopez here, and welcome to episode 2 of our new show called Drinking and Deep Dives with Chris Lopez, which involves two things I really enjoy: having a drink or two, but also going to some deep topics around real estate and investing and everything else involved with those, general topics. And the show came about because as this year has evolved and the market has moved faster and we've upped our game with the studio and the marketing team, I really wanted to get a way to start doing more current event content so we could get more news, more deals out quicker, and frankly, just have more fun doing it as well. Hence the name Drinking and Deep Dives. So today, another great show. The main topic is going to be comparing the down payments on an investment property, a non-owner occupied investment property of 15 versus 20% versus 25% down. Plus, I've got some updated numbers on how those recent guidelines on the higher points or the higher interest rates are going to affect your closing cost on the various investment loans. I actually got those plugged in my spreadsheet. I've got a great chart to share about the CPI, and I learned something new about this last week. And I'm going to take a few viewer questions that have come in the last week over email and a couple phone calls. One is, should I sell my property right now since the market is hot? The other is, should I quit my job to pursue a real estate career or real estate investing full time? So first, we're going to go into the CPI index. And so this is a chart on the consumer price index. Oh, stand by. All right, now we got the screen share. All right, so this is a chart that actually shows the breakdown of the consumer price index. And I actually have not looked at the breakdown of the consumer price index probably since some, college course around finance or economics back then. I know about the CPI, you hear about it, but I've not actually come back and looked at the breakdown of it. So it's really interesting. Housing makes up about 42% of the total CPI. So that's the biggest chunk of the pie out there. Transportation is about 16%. Food and beverage is about 15%. Medical is 8%. Education is 7%, recreation is 5%, and then some smaller stuff down below. So looking at the basics on there, housing makes up a big, big part of it. So why am I bringing this up? Well, it's because last month we started seeing some uptick in recent inflation news as well from the Federal Reserve Board. Whoever published that data, that inflation was at 4.1% for the month, or was higher than normal. And, for years, really since the Great Recession 10, 11, 12 years ago, a lot of people talk about inflation. It's not come to fruition yet, but looking at the way everything is now, plus all the last year's worth of stimulus money, it's got me really thinking a lot more about inflation. And overall, real estate is a great hedge against inflation. And so this is one of the things you have to look at in the market right now. We all know the market is hot. Properties are going for, quite a bit above list price oftentimes, and cap rates are getting compressed. Cash flow is getting harder and harder to come by. And that's not just in Denver, that's in Colorado Springs, and that's in many markets around the country. So it kind of brings up the question, well, should I sit around and wait for the market to adjust, or what do I do? And this is where you can't just look at cash flow on a property, right? So I don't think you can. I know a lot of people on the internet just look at property metrics and don't take it into the general context of the whole market. But I think you have to do that for long-term successful investing. You guys know me, I'm all about long-term wealth building. I really don't care about, making a profit in 30 days or a year. This is, hey, in 10, 20, 30 years, how can me, my family, my kids be taken care of and, not work for the rest of our lives? And this is where I think understanding CPI and looking at inflation is very important as well. We all know real estate prices are going bonkers, not just in Denver and the Springs, but all around the country. We all know what raw materials are, lumber and other raw materials, they are going insane right now too, just commodities. Those prices are going up as well. So that's probably going to drive up inflation. That's my best guess. I'm not an economist, but when prices start going up and we've had a ton of money dumped in the monetary system last year, probably a good chance we will see more inflation come down. But this is where we are in a unique time. While properties are not where they were a year, 2, 3, 4, 5 years ago in terms of cash flow, interest rates are really low. We still have that spread between cap rates and interest rates. Will they last forever? I don't think so. But for next year or two or a couple of years, I think we'll have a healthy spread between cap rates and interest rates. And the bigger the spread, where cap rates are at, say 4.5%, and your interest rates are, 2.5% to 4% for an owner occupied or investment property, you've got the spread there where your interest rate is lower than your cap rate. And that overall is a very great sign. The other thing, looking at what inflation will probably do to the economy, you have to consider, if I can put on long-term debt in that 3 to low 4% range, which is right around inflation, is that a better investment right now versus waiting for the market to turn? I think it is. There's no data showing that the market's going to drop off the cliff. We're going to see a bunch of foreclosures or REOs coming down the pipeline anytime soon. Prices will continue to increase. Rents are starting to increase as well. But I think the play right now is, we all know Denver is growing. Colorado Springs is growing. A lot of the markets around the country are growing as well. So buy properties in growing markets, put cheap long-term debt on there, and ride the wave of growth. Because inflation does tick up in the near future. What does that mean for investments? Well, real estate historically is a great, great hedge against inflation. So check out this chart on the show notes or YouTube if you want to see it, or Google it. Obviously there's a bazillion CPI charts out there, but when you do have a minute, go look at the breakdown of what actually makes up the CPI. I found it interesting, and it was a great refresher for me. Like I said, I'd forgotten about it for a decade or two, actually looking at it. So look at it and then take a step back and put this in context with your own investing, with your long-term plans. I know there's a lot of people out there with money on the sidelines. They're considering investing. They're not sure what to do. And I think a very smart play is putting properties in growing markets like Denver and the Springs on long-term debt, where you still have a good spread between cap rate and interest rate. All right. So before we move on the spreadsheet, I got a quick reminder that the 2021 Guide to Colorado Real Estate Investing book, it is coming out in about a week and a half. We're having our first in-person event since, pre-COVID times. So it's going to be great to see people in person. Please come out and join us. It's Friday, June 4th. Terrence Doyle was gracious enough to allow us to use his office space. We could crash his office warming party and have our book launch party there as well. Love you guys come out, hang out with us, grab a copy of the book, have some food, have some drinks, and network in person. All right, so moving on, I want to talk some spreadsheets here and actually go through comparing a 15% versus 20% versus 25% down payment on an investment property. And I brought this up because I'm looking to buy another property. I'm under contract right now. I was doing this analysis, and also 2 months ago or 3 months ago, Fannie or Freddie came out with those new guidelines that were making them buy less investment properties. Therefore, it's making investment property loans more expensive. The interest rates are going up. So what most lenders are doing is they're increasing the points up front to buy the interest rate down. So I got some updated numbers from lenders to go through some examples. And about 2 weeks ago, I sent out an email blast regarding 3 ADU off-market properties. As a side note, I sent that email blast out to the wrong email list. I did not mean to send out to the entire general public email marketing list, but a lot of you guys saw. If you haven't, look through your email archive to see those. I'm going to go through one of those properties and compare those different down payments and talk those updated lending numbers as well. So the first one we will look at is the 15%. And actually, before I go through comparing those, I just want to talk about the basics of the property. So this is a single family home with ADU, and this is in North Denver. It's actually unincorporated Adams County. It's a 3-bedroom, 1-bathroom main house. And then they have a backyard, a fence, and then there's a different structure with an ADU, which is a 1-bed, 1-bath. Might be 2-bed, 1-bath. These are 1-bed or 2-bed, 1-bath, separate structure on the back of the lot. So typical ADU property, separate structures. Purchase price is around $475,000. The rents for the front unit are $1,800. The rents for the back unit are $1,350. I've got the normal vacancy in here of 3%. I actually put 3% here instead of 5% because these have long-term tenants in here. And talking to the property manager, these are probably tenants that'll stay here for many, many years. So I think we could realistically put vacancy closer to 0, but 3% to be conservative. 3% rent increase and 5% for appreciation. I have property management, yes. You guys know I'm a big fan of property management, and I have property management at 10%. Now, the property manager currently managing it will charge 7%, but I ran up to 10% to help cover up other costs and just to be more conservative. Monthly repairs, I have at 8%, which is my standard default for underwriting properties. And the real estate taxes on this are about $2,500. Insurance should be about $1,800. Now, as far as utilities, the utilities are going to be zero to the landlord or the owner of this property. And that's because the tenants, it's actually the same family renting out front and back, and the properties are not separately metered. So they have the utilities coming to, one of the family members there, and they are paying the utilities amongst themselves. So in terms of landscaping, utilities, snow removal, all that stuff is all zero in the spreadsheet, simply because the tenants are handling it. So with that, the general cap rate on this type of property is a 5.4% cap rate. Now, keep in mind, cap rate is your net operating income. That is your rents minus all your non-mortgage expenses. That gives you your net operating income. On this property, your NOI is about $25,500. $25,500 divided by 475 gives you a 5.4% cap rate. And I'm stressing this right now because we're going to look at 3 different financing options. And cap rate, your financing option does not impact the cap rate on there. So it's a 5.4% cap rate. Now, is it a great cap rate? In the grand scheme of Denver, no, it's not. But for the current market conditions for a single family home, this is a really good cap rate. We don't see many cap rates above 5 when it comes to a detached single family homes. And that's what makes ADU properties just so attractive, is it's just extra income and it bumps up the cap rate. All right, so going back to the main page on here and scrolling back up to the financing options. Option 1 is doing a 15% down. And for 15% down, this works for single family homes and townhomes. For multifamilies and condos, those usually require a 25% down to get that 30-year conventional financing. But the nice thing about detached single family homes and also townhomes is you have the option to do 15, 20, or 25% down. Of course, all those comes with pros and cons, different interest rates, and different expenses. So it's 15% down. 2 main things come up here. I'm going to have a higher interest rate, and I have to pay mortgage insurance. Anytime you put down less than 20%, you're paying mortgage insurance on a property. So I'll talk more about that in a minute. So I got the purchase price of $475,000. I've got the acquisition cost at $16,631. So where that comes from is that is $2,500 in just hard cost acquisitions, and then the interest rate point buy down of 3.5%. So 15% down regardless. Before these changes a couple months ago, you're already going to have a higher point buy down. But now with these recent changes, your point buy down is higher across all investment properties. So 15% down right now, 3.5 is what I've gathered from talking with some lenders. So that means 3.5% of the mortgage balance. So the mortgage balance is $403,000. You multiply that times 3.5%, and that gives you the points you have to pay to buy the interest rate down. Now, if you don't pay it down, your interest rate is going to be higher, and it comes down to where that sweet spot is. So $16,600 for the loan cost, or for the acquisition cost, which is some hard costs for appraisal and standard closing costs. Majority of that is point buy down at that 3.5%. Then that $1,500 loan cost estimate and a down payment of about $71,000, and that's 15% of $475,000. That brings our total initial investment to $89,500. So basically $90,000 all in to get this property. And it shouldn't need any immediate repair costs, anything like that. So about $90,000 all in. Now going to the cash flow tab here on Joe Massey's spreadsheet, you can see here we're actually estimated to be at a negative $89 in annual cash flow. And I call that about break even because our underwriting is fairly conservative on here. But this also pre-populates the monthly mortgage insurance. Now, when I've looked in the past on 15% down properties, that mortgage insurance has ranged from like $80 to $120 from the few closing statements I've seen on there. Joe's spreadsheet is estimating about $145 a month, and his just uses some averages. You, of course, always will get an accurate amount once you're going to contract their property, and your lender gives you the amounts to cover. So with that, we've got total rents of $37,800 minus all the expenses, $25,500 in NOI, minus your mortgage payments, minus your mortgage insurance, and you're at basically a break even for the year. So you're at a negative 0.1 cash flow. So I'm going to keep this screen up, or the spreadsheet up. And now we're going to look at the 20% down option. I'm going to do my best to resize and talk at the same time. So now I've got the exact same numbers plugged in here. Rents, operating data, it's all the same on here. Now the biggest difference is I have 20% down payment on here. So now what that means is a couple things. One, I don't have to pay mortgage insurance because this is at that 20% down payment threshold, which means no mortgage insurance or no PMI. But it also increases my down payment. So my down payment goes from $71,000 to about $95,000. So a good chunk more of money to put down. However, my acquisition cost drops some because it should be about 3 points to buy the interest rate down on a 20% down property. And that's going to be 3 versus 3.5% down on a 15% down payment. So other differences on here is the interest rate will be about 1/8 lower. So this will be 4.125. So going to the cash flow tab here in Joe's spreadsheet. Now what this does is this bumps the cash flow up to $3,400 a year. So that's better cash flow than zero or break even. So cap rate's the same at 5.4% because that does not matter for financing options, but the cash on cash goes to 3.1%. So it goes from basically like 0% to 3.1%. All right, so that's option 2. Now let's find option 3, which is a 25% down. So again, it's all the same operating data on here. Purchase price the same, operating data the same, but now I'm putting down 25%. So now my total down payment is about $119,000. Now my acquisition costs are going to be a little bit lower. I still have that about $2,500 in this, general closing cost, but should be about 2 points in interest rate buy down. So 2% times 356, the mortgage balance, gives you a total about $12,000 in acquisition cost. So on this property, I'm all in at $133,000 or $132,000. No PMI, but now my interest rate is 3.875%. So go in the cash flow tab here. Now that gives me an annual cash flow of $5,400 and an annual cash on cash of 4.1%. All right, so I've thrown a lot of numbers at here and went through that very quickly. I'm going to go back to all the input tabs on these and do a quick comparison and talk some pros and cons and give you an opinion on what I would do and tell you what the spreadsheet would do for long-term wealth building. So at the 15% down, your total investment is about $90,000 at a 4.25% interest rate. At 20% down, your total investment is about $110,000 at a 4.125 interest rate. At a 25% down payment, you're all in for about $132,000 at 3.875% interest rate. Now, looking at the returns on here, let's compare the returns. Now, with cash flow on the 15% down, cash flow is not great. It's basically break even. On the 20% down, we're at $3,400. On the 25% down, we're at the $5,400. So look at it this way. And I tend to very rarely go in the middle. I think, either like 15 or 25% down. That's what most people prefer. Very few people go like middle of the road, it seems, from what I've done personally and also working with clients, depending on risk tolerance and numbers. So I'm just going to leave out the 20% right now and compare 15 to 25% to go to the extremes. So at the 15% down, I'm all in for $90,000, making $0 a year approximately. Or I can invest an extra $40,000 and make $5,400 a year. So how do we look at that extra $40,000? Well, first off, you have to have that $40,000 to invest. But that extra cash, it has an opportunity cost on there. So I look at this in 2 ways. You could say, great, This $40,000 makes me an extra $5,400 a year. So 5,400 divided by 40,000 is a 13% return on that money. Okay, pretty good there for a cash on cash return. Now let's leave the cash on cash return out, because that $40,000 I could put down to make an extra $5,000 a year, or I could keep that $40,000 in the bank for reserves, or use that to go out there and buy another property. $40,000 is a significant chunk of money. It's a very significant chunk of money to me and most investors. Now, if you look at the total returns on the property, the total return on the 15% down is 39.3%. And that factors in appreciation, debt pay down, and depreciation. Now, on the 25% down, the total return is 30%. Listen again, 15% down, your total return is estimated at 39%. On the 25% down, your total return is estimated at 30%, which is weird when most people hear this, because you're putting down more money, you expect I'm getting better cash flow. Why is my return not better? Well, your cash flow is, remember, there's 4 ways to make money in real estate. Your cash flow goes up 4% in the 25% down scenario. But the other brackets of appreciation, debt pay down, and depreciation on tax benefits actually decreases. Because remember, on these returns of appreciation and depreciation, they're exactly the same regardless of your debt financing, because the properties that you're buying at 475. So you're going to get the same appreciation and you're getting the same tax benefits. However, we're estimating a $24,000 return appreciation at 5%. $24,000 divided by my total cash all in of $90,000 gives me a higher return than $24,000 divided by $130,000. So this is where you can't just look at cash flow. And this is where spreadsheets become very interesting, because if you plug numbers in a spreadsheet, almost every single time it'll say higher leverage is better, because you'll make longer term, you'll make a greater return in the longer term wealth building aspect of it. And this is where it comes down to your risk tolerance. Do you want more cash flow a day, an extra $5,000 a year, which does give you some buffer? Or do you want more money in the bank and you care about less cash flow, but you want a higher return on your money? Personally, for where I'm at in life right now, and also my risk tolerance, I like the 15% down option. And that's because I get higher leverage and I'm less concerned about the cash flow day, because whether I'm making zero, an extra $5,000 a year, it's not a big difference. That $5,000 a year is not going to retire me from my job or my business anytime sooner. Not going to do it for most people. And I'd rather keep that $40,000 in the bank to save up to buy the next property $40,000 sooner. Otherwise, it would take me 8 years to get that $5,000 back in the cash flow from the 25% down option. Of course, I stay very cash heavy, so I'm fine with tighter numbers on cash flow. The other thing to look at too is on that 15% down option. If I want to get a little bit less conservative with the numbers and be more realistic, I'm going to run vacancy at 0%, because it sounds like these tenants will stay here for a long time. This property is in pretty good shape. The tenants take really good care of the property. I'm going to drop repairs and maintenance to 5%. And the actual cost from the property manager is 7%. So if I don't have the vacancy, that means I'm going to have a lot less renewal fees and marketing fees than property manager. So I don't necessarily need to round up that 7 to 10%. So now in that 15% down option, now that cash flow is maybe around $3,000 a year. So does that mean I make $3,000 this first year? No, it doesn't. But in my mind, I'm expecting to make $0 to $3,000 the first year, which is a much more favorable swing than just $0. Now, of course, I could do the same thing on the 25% down, make an extra $3,000 on there, but I already want to look at that 15% down. So here's my train of thought that I go through when I evaluate properties. The other thing to keep in mind is I'm putting this money on 30-year fixed debt. Rents and prices should continue to appreciate. I don't think prices will appreciate like they have this last 6 months, but prices will probably still continue to increase at a slower, not double-digit rate, because I think that's the way things will go and it should go for the market. The other thing is when you put 15% down, PMI drops off around the 3-year mark. So on this spreadsheet, it's estimating about $1,700 a year towards PMI. That won't be the actual cost, but it'll be the ballpark of there. So in 3 years, I can expect a bump of another $1,500 to $2,000 a year in cash flow from PMI automatically dropping off. So if you guys have questions on it, reach out. Check the blog post as well, because we'll have some screenshots of these side-by-side comparison, because this is a great thing to think about, understanding the numbers, understanding the options, and also putting this in context with what's going on in the market, with what's going on in economic terms, with probably inflation picking up, and also what your risk tolerance is. Now, I do have one more wild card on here before I move on, and that's actually going through a local bank to do a ARM loan through a portfolio product. So this would be like a First Bank or a Key Bank, where they lend out their money and they don't turn around and sell to the secondary markets through Fannie and Freddie. So with those, the reason I'm looking at those is because that recent spike in interest rates and fees for 30-year conventional products did not come down, and that does not impact banks' portfolio products. So generally speaking, if you go out there and buy a single-family home like this, you do need to put 20% down, and it'll be a 5 to 7 year ARM, and you'll be anywhere from sounds like a point to 1.5 in closing costs for just the lending stuff. So quite a bit lower than that 2 to 3.5% point buy down we're talking about. So does doing that make more sense? Well, let's pull up that spreadsheet and compare it to 15% down. So I'm getting these spreadsheets pulled up here. And now on the right-hand side of the screen, I got my 15% down option that I've covered. And now I got the 20% down option through a local bank. And these are just some terms I use from some, other deals under contract, and I just extrapolate it to our property here. So I put the acquisition cost at about $7,000. So that's that same $2,500 in hard cost, but rather than being 3.5% in point buy down, it'll be about 1% through there. And this will be like a 5-year ARM, so 5-year fixed rate, and then after year 5, the interest rate will start floating. So that means it adjusts every month. So at 20% down, I'm all in for about $104,000 for down payment, plus all the acquisition costs. And my interest rate should be in the high 3s. I put 3.875% compared to 4.25%. So there's a big difference. 104,000 compared to 90,000, and the interest rate of 4.25 compared to 3.875. So with this local bank, I'm actually putting more money down, less acquisition costs, getting a better interest rate. But I'm still putting down about $24,000 more. And this is a key factor for just what spreadsheets tell you to do for long-term wealth creation. So going to cash flow for the ARM product, I will cash flow about $4,000 a year. So I'll put 20% down, no PMI, but be at $4,000 a year, compared to my $0 to $3,000 estimating on my 15% down. And to be fair, if I did that same underwriting on the 20% down ARM, I'd be between like $4,000 to $7,000 a year. All right, so which is better? Do I want same question we had here on the 25% down? Do I want more cash flow now, or I want less money in my pocket? Same thing, is an extra $20,000 to $25,000. Where do I have that in the bank, or do I want an extra $4,000 a year? There's that question, and then there's the long-term interest rate question as well. I really think on a property like this, in 3 to 7 years, you'll have a chance to refi, cash out refi, put a HELOC on there, or sell in 1031 to capture some of the equity from debt pay down, but mostly from market appreciation. But maybe the market really stalls out. Maybe it's not a favorable time to pull out the money from interest rates because they spike up, or maybe it doesn't make sense to do a 1031 because, all the chatter about, reducing 1031 benefits, maybe that comes to fruition in 5 years. I can't do a 1031. And maybe my plan B is to hold this property long term. So in this scenario, I would still stay with the 15% down option, because I get the least money out of my bank account to buy the property. But then for my risk tolerance, I am very risk adverse to long-term interest rates, which this happened to me once I started my family having kids. I became a lot more conservative. So since I am more conservative now, I'm definitely concerned about future inflation. I'd rather spend an extra few dollars to lock in a 30-year fixed note at 4% ish, just in that off chance I don't reposition the property or change out the loan in 5 to 7 years. But now I've got a great 30-year hedge against inflation. So if the ARM product had a much lower interest rate or has similar numbers, I would reconsider it. But for that small difference, I'd rather pay, and I look at it as basically an insurance premium, an extra couple dollars in point buy down, that long-term interest rate locked in, and it can protect me against future inflation, and it's a cheap hedge as well. So again, if you have questions on here, reach out. I love talking about this, and also check the show notes. All right, so moving on to our questions. This is a question I get. I talk to quite a few people about this every single month. And it's basically, should I quit my job to pursue my real estate investing career or pursue a real estate career? And so this often comes from two types of people, just pure investors wanting to do fix and flips or BRRRRs and really go the investing route, or people looking to leave their job to become a full-time real estate agent or some other type of real estate professional, typically real estate agents. And then should I quit my job? So it's a very, very loaded question. And before I get into details, my short answer is, I think for most people, it's no. And here's why. Because a lot of people want to buy rentals or house hack along the way. Well, if you go from your W-2 job, now you get a self-employed, lenders look at you a lot differently. I would definitely talk to a lender and also Google it to understand when you become self-employed, it changes your lending dynamics. Because for most people, the first year or two that they are an agent or they're a fix and flipper, they're not making much money because they're building a business, they're reinvesting in the business. And so lenders generally need 2 years of self-employed people. They need 2 years of good tax returns. So if year 1, year 2, your tax returns are $0 to $10,000 in profit, you're like, oh, cool, I wrote off everything, so I don't have a tax burden. That's great. The other hand is lenders look at it and say, oh, you don't make any money, we can't lend to you. So a lot of people don't look at that lending in there. And I think the other thing too, when I talk to people, I'm like, great, what's your current schedule like? What's your current pipeline? What's your activity like? And people are like, oh, I'm doing this weekend. I'm relaxing today. I'm doing this. If you have time to do that, it's not time to transition out of your job. If you're not already completely maxed out between your job and your side hustle or your future career of investing or being an agent, you should not leave your job, in my opinion. And I say this because in my previous business, I did a lot of work where I coached people and had marketing programs and myself where people would leave their job to become an independent contractor. And there's a very, very high failure rate. And most people are like, oh, great, when I can leave my job and spend time on here. And that, if you cannot already do a lot of your work in 15 and 20 hours a week on your side hustle, leaving your job will not do anything magical for you. If you're not already busy doing money-making activities, I do not recommend leaving your job. Leaving your job does not do anything magical for you. Because what happens is whatever task you have, I forget what rule or principle this is, whatever task you have or time available, your task always fill up. You know, the old saying, you want something done, give it to a busy person. So if you're not already incredibly busy with your side hustle, your future career, I do not recommend leaving your job. And people are like, oh, well, my job doesn't align with my interest, my personality. I think that takes a back seat right now, unless your employer is doing some very morally egregious or illegal things. If you don't like the job, suck it up is my advice. Go out there, grind at it, and grind at your side hustle. And you'll hit a tipping point where you are so busy, you're like, you know what? I just have to leave my job, go out there and do more deals, get more deals done. Because if you can't make money while you're part-time, going full-time is not going to make any darn difference. And also think long-term. If you're looking to build a long-term career of 10, 20 years out, then another year or two of working a job you don't really like or having a cruddy commute while you build your side hustle, it doesn't matter. I'm only mile 3 or 4 into my marathon. I've been at this for 4 to 5 years now, and I've got a 20-year game plan. People overestimate what they can done in 1 year, but underestimate what they can done in a decade. So definitely think long-term and make sure you talk to your partner, your spouse, whatever it is. And also make sure that you have a realistic financial picture for lending on your projects, whether it's a hard money lender for your fix and flips or a conventional lender for your house hacks or rental properties. Make sure you tell them what you're thinking about and get their opinion. The other thing too is, what's your financial cushion? Do you have a minimum of 6 months of cash in the bank, I'd recommend 12 months cash in the bank. Because when you leave your job, that income stops coming in every 2 weeks, and you are 100% what you do. You eat what you kill. You earn what you go out there and do. So make sure your financial runway, because becoming an agent, becoming a flipper, you're not going to go out there and make a profit in 45 days. You have to look at this in 6 to 12 months. When I became an agent, I said, great, I expect to make a profit in years 2 to 4, and I'd plan things financially for money in the bank, along with my wife's income and our expenses. I'd plan things where I could invest money in the business every year and not get a profit till years 2 to 4 is my expectations. So really think about this before you go out there and quit your job. All right, the next question. Should I sell my property right now? And this is really geared towards people that bought property, 5 years or greater, maybe 3 years. But there's a lot of people I talk with, and a lot of people around Denver. They've got a couple rental properties, or they've got a couple, nomads or house hacks turned to rentals. And we all know what the market's done the last 10 years. It has appreciated. And while we've seen prices go up, people are like wondering, wow, I've got multiple 6 figures in equity. What should I do? And it becomes an interesting talking point, or an interesting discussion point, because right now in the market, it's a great time to sell. But then what do you go out there and put the money into? Now, the two things to keep in mind here, or a couple things to keep in mind here, is what are your long-term goals? We're going to look at the property. You have to say, great, what are your goals? Are you in a point in your life where you just want more cash flow? Maybe you just want to retire and you want to have a lower risk. It might make sense to pay off the properties. Or if you're at a point in life where you need to acquire more rentals to build up your longer-term wealth and net worth and future cash flow, it might make sense to pull out equity. So number one, look at what your goals are, and really have a heart-to-heart discussion with you, your partners, your family, whoever is involved in your life, and really write the numbers down, consider it. And also talk with me and my team. This is what we do. This is what we enjoy as well. And then you have to analyze the property. Okay, what is the property doing right now? And the way you analyze properties right now is you don't look at what you bought for it 5 years ago. Oh, great, I bought for $300,000. I'm making, 12 hours a month in cash flow. You have to evaluate in today's terms. If I were to rebuy this property, what's the performance like? And for a lot of properties around Denver, rents have gone up, and so have prices. But prices have gone up higher than rents have. So you're going to have higher appreciation, higher equity than you will for the rents. So that turns into a different analysis there. If you look at that property today, that property is often a very low cap rate. My rule of thumb, which I learned from Lon Welsh, is once a property drops below 4% cap rate in today's terms, today's rents, today's expenses, today's prices, that's today's cap rate. Not what you bought 5 years ago for. That's today's cap rate. If it drops below 4%, that's a indicator to really look at, maybe I should sell this property. Now, of course, you want to look at, maybe I should pull out money from this property through a HELOC, through a cash out refi, or through some type of lending product. Should I pull out that equity on there? And that comes out to what terms you get on the property. Well, if it's a poor investment property, doing a maximum cash out refi of at 75% LTV is probably not the best use, because it actually turns a property into a negative cash flowing property. Because think about this. You are essentially rebuying the property at a 25% down payment. And that's why I have to look at the property today. Would I buy this property today at a 25% down payment? If you would, great. Maybe you keep it. Maybe you refi. The majority of properties I look at and majority of people I talk to, the answer is no, I wouldn't. And therefore, it doesn't make sense to go out there and do a cash out refi. And so then the other thing I have to look at is, great, if I pull out money or sell in 1031, what am I going to do with the money? The market is really hot. Hey, if you sell right now, you're going to get multiple offers and probably get a very high sales price. Great. We all know sellers right now on the driver's seat. That's great on the sell side, but now on the buy side, whether you're staying in Denver, Colorado Springs, or going into the market, they're probably going to be like the Denver market, where it's already a hot market. You're going to have a harder time buying the property. Well, which means it's harder to do a 1031 exchange. And that's maybe where you're going to look at doing a reverse 1031 exchange. But then also people say, well, prices are high. Does it make sense to go out there and buy another property at these higher prices? Generally speaking, yes, it does, under two conditions. You are re-leveraging up because you're getting leverage. you're buying new properties at a 15 to 25% down payment, and leverage is a big reason why you can make money in real estate. The other reason is you need to buy a better rental property, a better performing rental property. If you are selling a property that's a 3.5% cap rate and you go out there and buy a 3.5% cap rate, that's not a good investment move. It's not going to give you those better returns. But if you sell a 3.5% cap rate and then re-leverage up and go out there and buy a 5% cap rate, that's where it makes sense. So you have to buy with leverage and buy a better performing rental. From all the analyses I've done, those are the two general rules of thumbs I put it down. As you know me, I'm like a big keep it simple, stupid guy. And those are two rules of thumbs that I've identified when looking at properties, if it makes sense to sell, 1031, and trade up. So I know I threw a lot of numbers at you here on should I sell right now. It is a mixed bag, but overall, if you're looking to optimize your portfolio, increase your cash flow, increase your future net worth, then yes, it does. But you have to take into consideration all the stuff I talked about. And I realize you probably have not retained a lot of that, and also threw a lot of numbers at you there. That's why we do have our return on equity spreadsheet, where we do plug in your property data into our spreadsheet, and it runs 4 scenarios. What happens if I keep it? What happens if I do a maximum cash out refi? What happens if I do a safe refi, meaning it won't be a negative cash flowing property? And what happens if I sell and do a 1031 exchange? And so I do not make the spreadsheet publicly available because it's very nuanced. And you also need someone that understands it to help like coach you and give you context to the numbers. So if you do have a portfolio or properties of this, reach out to me. We are building out that spreadsheet. We're building out portfolio analysis, and we can do an analysis on it and help you run the options. And we will really just give you the options and say, here's what the spreadsheet is saying. Here's how to interpret it. Here's our thoughts. Here's what we do in your shoes. What questions do you have? And we want you to come up with a game plan on here. Because I know if we give true advice out there, we will win people's business. And a lot of times I tell people, you know what? You should keep this property based on where you are in life and what you want to do. Or sometimes, you know what? Just refinance. It's good. And we don't make money off it, which is fine. But if we give great value, we will win in the long run. But that's the only way to do business, by providing value and earning people's trust. And I love doing those analyses because they're fun, and every single one is different when you take in that property and also people's goals. So if you want that, reach out to me or go to the website and fill out the investment consultation. And then either myself or Chelsea will get with you to sit down and do the return on equity or portfolio analysis. All right. Well, that's it for this show. As we wrap this up, I do appreciate feedback. I would love to start having people join us on these lives. I know this is show 2, publishing the podcast. So start joining us live on Wednesdays at noon Mountain Time. If you can't make it, send us an email. I'll get your questions in here. And just if you have questions or comments, please reach out. This is stuff that we are passionate about here at the Envision Advisors. We love doing it. So we always love talking numbers. All right, Colorado, make it a great day.